Global markets came under pressure on March 20 as the ongoing US-Israel conflict with Iran continued to rattle investors, pushing oil prices higher and raising concerns over inflation and interest rates worldwide. Wall Street ended sharply lower on Friday, with major indices weighed down by losses in heavyweight technology stocks as the conflict entered its fourth week. The S&P 500 fell 1.49% to 6,508.32, while the Nasdaq Composite dropped 1.98% to 21,653.71. The Dow Jones Industrial Average declined 0.92% to 45,599.11. Major tech firms including Nvidia, Microsoft, Alphabet, Tesla, and Meta Platforms all recorded losses, dragging broader markets lower. The US also moved to reinforce its military presence in the region, adding to fears of prolonged instability and economic fallout. In a bid to stabilize oil markets, the United States temporarily eased sanctions on Iranian oil, allowing the sale of crude already stranded at sea. The move is aimed at easing supply pressures and cooling prices, with analysts estimating that millions of barrels could enter global markets over the coming weeks. However, officials have stressed that the relief is limited and does not signal a broader shift in sanctions policy. Across Asia, markets showed mixed performance as investors reacted to global volatility and energy price shocks. Japan's Nikkei 225 declined amid risk-off sentiment, while Hong Kong's Hang Seng Index remained under pressure. In contrast, China's Shanghai Composite posted modest gains, supported by expectations of government stimulus. South Korea's Kospi and Australia's S&P ASX 200 also faced pressure as rising energy costs weighed on investor confidence. Oil prices remained elevated despite some easing, staying above $100 per barrel after surging earlier in the week. Markets continue to factor in supply risks linked to the conflict, particularly around the Strait of Hormuz, a key route for global energy shipments. Analysts warn that any further escalation could tighten supply and keep prices high. The surge in oil prices has complicated the global monetary policy outlook, with investors increasingly concerned that central banks, particularly the US Federal Reserve, may delay interest rate cuts due to renewed inflationary pressures. Overall, markets are expected to remain volatile in the near term, with geopolitical developments, oil price movements, and central bank signals continuing to drive investor sentiment.